Thank you for joining us. It is Fed Day, and I'm pleased to have with me Richard Excell, friend of the firm, and to talk about inflation, soft landings, and the road ahead. Rich is an instructor of finance at Gies College of Business, University of Illinois. He was most recently a portfolio manager for Wolverine, which is a global macro fund with an extremely distinguished track record. He also hosts the Investment Exchange Forum and Macro Matters podcast for the CFA Society, and he has probably my only must-read macro newsletter, which is the Stay Vigilant on Substack that I highly recommend. So get into the obligatory disclosures. Obviously, nothing in this presentation constitutes investment advice of any kind or solicitation. Any opinions expressed are solely those of myself and Rich, and forward-looking statements, of course, are no guarantees of future results. How's the old saying go? History doesn't repeat, but it does rhyme. So with that, Rich, first of all, thanks for being here. And let's jump right into it. You know, Powell spoke just a matter of moments ago. I pulled together some of the quotes that kind of resonated with me. You know, it seems to be, you know, as you were just saying, kind of a risk-on reaction by the markets. You know, what are your thoughts?
Yeah, first of all, thanks for having me, Ben. It's always good to catch up and chat. I read it very much risk on, and you know it's interesting because I was looking at the data that we've had over the last few weeks or so. Most importantly, I was looking at the price action we're seeing in treasuries, price action we're seeing in the dollar, things like that. You know, dollar yen at really critical levels, treasury yields looking like they want to break out. I'm like, are other markets telling us something might be risk off here? And is the equity market, you know, completely oblivious? And it looks like maybe the equity market had it right because it's more, and now we're seeing yields kind of pull back and Dow yen pull back, and you know, it's not always the case that equities have it right and the other markets have it wrong, but that definitely seems to be the case. I was definitely surprised. I mean, you know, one thing we were talking about was like financial conditions are weighing on the economy. It's interesting he says that because I think, you know, I talked to some people and then we look at the Goldman Sachs Financial Conditions Index, which I think a lot of people look at because Bill Dudley created that at Goldman and brought it over to the Fed. And that's actually shown like that there actually conditions have been getting easier, not tighter, but there are measures you could look at, like the Chicago Fed financial conditions say it's getting tighter. So I'm trying to parse through this a little bit to try to say, well, what are they looking at that we should be looking at type of thing, because that's always what it is. Um, and I think, you know, generally speaking, like you talk about, like they still thinks it's appropriate to cut this year. So we saw, you know, some cuts put back into the curve, and that's something that I've been talking about on other podcasts leading up to this. That it was a pretty amazing repricing in some ways. If we go back to January, what the market was pricing in, they've had three cuts priced in by June, and
Yeah.
almost seven cuts priced in by December of this year. And by February, about half of those were gone. And you know, and by Monday or you know Friday last week, Monday this week, you know, where it was basically less than three cuts priced in for the end of the year, not for June, for the end of the year.
Yeah.
So that, I mean, that was a pretty radical repricing of short-term rates, and risky assets had done pretty well in the face of that, which is somewhat telling. And now I think with what Powell tells us today, and what we see with the dots, et cetera, is that, you know, that three cuts this year is basically being codified, and the markets are like, hey, we're good with that, and responding in kind. I think they feared that it could be even a little worse than that, and I was a little, I didn't know, because you never know, because they're updating the dot plots for the first time in a quarter. You never know what's going to happen, and you know, so but this, you know, it came out, and in fact, it was actually, you know, maybe a little bit better than people thought it was going to be, and you know, and they're reducing the quantitative tightening, you know, slowing down the, you know,
Yeah.
from, you know, I didn't see the full trajectory of it, but the expectation was that they're going to slow down from 95 to 80 to 65, all the way down to 15 at some point. And it seems like the market's responding as if they, you know, I didn't get into the details of that before we jumped on here, but I would guess that, you know, he certainly referenced slowing in the QT. So that's, again, that's another thing that's less of a headwind for risk. And I think that's what we see in the markets.
Well, and it's interesting too, kind of this, there's a bunch of talking heads leading into this that were saying, Apollo's chief economist, I think, was a perfect example. He said, I see no rate cuts this year. And a lot of people were saying maybe one, maybe two. Jim Bianco actually made a good point, which I think is interesting about, this being an election cycle. And he had a good comment, which I think, to paraphrase correctly, was that, the Fed isn't partisan, but they are political, meaning, they don't have a horse in the race. So as it relates to a specific candidate, they don't want to make anybody look good or bad, but they're political in the sense that they recognize that they're going to be part of the conversation if they start, getting too close into the end of the year. So he was saying, that was an argument that the Fed's window for cuts might really be constrained to just kind of the summertime, and there wouldn't be any cuts in the back, in Q4 when you get into the conventions and the actual election. So yeah, to your point, I think Powell kind of codifying 3 cuts and to say that number too, as opposed to leaving it open to interpretation somewhat, is markets saw it as risk on.
Yeah, I would agree with Jim Bianco. I wouldn't expect much in September, November. And I frankly would agree with Torsten and Apollo. And I don't see any cuts this year. I'm obviously wrong, but to me, the Fed's got a dual mandate of price stability and full employment. And we are still pretty darn close to full employment, 3.9%, which is up quite a bit from the lows. 3.4% was the lowest unemployment, and a lot of SOM rule triggers, like SOM rule at the 3-month moving average of unemployment goes up by 50 basis points. We've always had a recession, and it's only gone up by 27 basis points on a moving average basis, so we're not there yet, but it's getting worse in some
Yeah,
ways. But still, in absolute terms, less than 4% unemployment, it's still a pretty strong labor market. And then price stability, we don't have it, right? And this is what I know the chart that you've got brought up here that we looked at before, you know, all this hope of this inflation gently falling back to the Fed's 2% target, which was a great narrative for a lot of last year, just isn't proving to be the case at this point. So I don't see the case for it, but I'm obviously wrong. So what do I know?
yeah. Well, it's interesting too. He seemed to kind of reaffirm the 2% target, which I also thought was interesting because I've been very vocal about the fact that I don't see any state of the world long term in which the Fed can keep the 2% target. In fact, there's been a lot of people saying that that's kind of lip service and they're really managing to a 3% target, which is, I mean, let's be real. I have slides in the back that we can talk about this, but with the deficit this large and the debt this large, monetizing the debt through inflation, is a very real option. Governments have done it in the past, and so that's a reason to argue that the Fed would want to allow a little bit of inflation to run. But I mean, again, when you look at the data, it is looking like inflation might have bottomed out here. And again, I mean, I think that's a reason for gold kind of hitting all-time highs, despite the fact that you've had ETF outflows. There's other macro kind of geopolitical reasons there too. Central banks selling dollars and buying gold, but it does look like higher inflation is here to stay.
Yeah, if you go back to that previous slide real fast, I just think it's important because I mean, just to think about this impact on inflation, and with the class that they teach, we build some economic models, and you know, I have my students build models for inflation and models for growth, and one of the most critical drivers of their inflation forecasts, and there's a lot of things that feed obviously into inflation, but it's commodity prices, and it's not just the tradable commodities because you can argue that tradable commodities get dislocated for different reasons and with systematic money, et cetera. But the ones that we're looking at here is the raw industrials index, which is all commodities that aren't traded, that businesses use, et cetera. So it's really kind of fundamental to what's going on in the economy, prices that we're seeing. And as you can see, these lead in the inflation measures that we get, either CPI, PPI, or PCE by 6 months to a year ish. And we've certainly seen that in this past cycle. These commodity prices led inflation much higher, and they peaked and rolled over early or late in 2021 throughout all 2022, and that was the disinflation we were seeing in all of the other inflation measures we get. Those bottomed April of last year and have been moving higher ever since. A series of higher lows and higher highs, which I'm not looking at this technically, but if you were saying I would want to buy
Yeah,
that stock, and that's heading higher, and and then we see it now in the tradable commodities, right? With oil and copper,
yeah.
things that are tied to global growth, not just U.S. growth, but they're pointing higher. And what does that mean for inflation? And I think you're absolutely right that the policymakers in DC have decided that inflation is the way out of this, because when you've got too much debt, which objectively we have too much debt, right? We're greater than 100% debt to GDP. That's been a trigger level for countries in the past. Um, there's three ways out of too much debt, right? You can default, which we're not going to default. Is even though we kind of play chicken with the debt ceiling all the time, we're not going to default. So that's one you can't do. Restructure, which is what prudent people generally try to do, um, but we've obviously shown no political will towards restructuring any of our liabilities. And so the only other way to get out of it is to inflate our way out of it. And it's in some ways, it's the path of least resistance for policymakers.
Yeah,
And I think that the Fed knows this, right? The Fed can see this in the decisions that are being made fiscally by both parties. It's not a partisan. There's one thing that I guess you could say is one bipartisan thing in DC is that they both agree that they want to spend more money. They just maybe don't agree where they want to spend it, but
exactly.
and I think the Fed realizes, and they should understand that that's going to be more inflationary, and so to want to be dovish in the face of that, I think it's kind of interesting, and I personally think it it increases the odds of like a 1960s redux where the Fed cut rates when they thought they had things under control, and then we saw a massive repricing of inflation and led to some other problems. And so I don't know. Well, that's kind of how I see it. I mean, I'm not trying to dig in my heels here, but I do think that some of the things that I'm seeing suggest that if this inflation is going to be a problem that's with us, and consumers don't look at year over year changes of inflation, right? They what they look at is the cost of what it takes them when they go to the gas station or the store or whatever, and that's permanently higher. And so they're going to ask for higher and higher wages to work,
Yep.
and the labor market is strong enough that they can do so. And so I think these are things that one thing I say in my blog all the time is inflation isn't a number, it's a mindset, right? And I think Bernanke knew this, and that's he was fighting against that deflationary mindset post the great financial crisis of not wanting that deflationary mindset to creep in where I'll just delay purchases because prices will be lower in the future. And that's what we saw in Japan, and that leads to
Yep.
a vicious cycle on the downside. Um, Inflation is also a mindset, and I think we're seeing inflation expectations creep higher in the whether we look in the TIPS data, whether we look in the University of Michigan data, or the 5-year forward data, and I think we're seeing that this inflationary mindset is creeping in to consumers, and I think that makes the Fed's job a little bit harder going forward.
Yeah, that's a crucial point about inflation expectations. I mean, that's one of the first things like you learn in kind of economics 101 is the expectations of forward-looking inflation impact behavior now, which then becomes self-reinforcing. And a lot of the models for predicting inflation look very closely at inflation expectations. Yeah, this is Torsten Slok from Apollos here, and here's what he's saying is exactly what we were just talking about is that 2% target. I mean, it's a lot of people have just been saying it's that's kind of fantasy land to get back there. So let's go back to commodities because that's interesting. Copper is a perfect example. So this is a space we look at very closely. And copper for a long time last year had kind of been signaling risk off. A lot of that was recession in China, which is a big user. To us, we were looking at that as a potential leading indicator of recession here in the States. And then all of a sudden, in the last couple of weeks, copper has started to tick higher pretty robustly. And as they say, the old saying, Dr. Copper, is never wrong.
Sure.
So walk us through this chart because this is interesting.
Yeah, I think you're right. And so there's a few things going on here. So a couple of things we've got in white line, we've got copper, and blue line, we've got oil, but I've put them in terms of gold. So I basically have divided them both by the price of gold, and I do that for one reason, and that's to take out the foreign exchange effects on the price of the commodity. I'm just trying to say, okay, there are some dollar moves and there's other currency moves going on. Let's take that FX effect out and just look at what would be the pure price of the commodity in a kind of a base level gold level, which gold is what it is, right? It holds its value over time, and everything else moves around it. And so it's a way I like to look at the commodity markets to not normalize them. And now the other things I'm looking at, and the key one here, I think, is this purple line. And the purple line you see kind of looks like a sine curve, but what it is the OECD Global Leading Indicators Index. Okay, so it's looking at all the developed countries. It's the G20 actually, and so it's telling you what's going on in the global economy, right? The leading indicators, and it's similar to the leading economic indicators that we have here in the U.S. They're just doing it at a global scale. And I think you're absolutely right. Like this, the story when we look at copper and oil in the last year was, yeah, we've seen some strength in the U.S., but yeah, China's in recession, Japan's in recession, UK's in recession, Germany's in recession, everyone's in recession other than the US. And so the global commodities were struggling as a result. But what we're seeing here in the last few months is that this global leading indicator is moving higher, and this is not just being driven higher by what's going on in the U.S. It's these other companies or other countries, I should say, are bottoming and starting to move higher. And as we can see, the commodities will respond and move with this global leading indicator at some point, because ultimately that's what they're commodities, right? If there's stronger economic growth means higher demand, right? And higher demand in a relatively fixed short run supply means higher prices. And that's, I think, what we're going to see. And that's what we're starting to see if you look at the prices of oil and copper. And I think that's what's going to continue to drive these broader commodity indices higher, which I think leads to leads to much stronger. It doesn't have to. We're not talking 9% type of CPI again, but we're not going to 2%, and it's
Yeah.
just it's just going to be a persistent problem throughout here. Now, the other thing I have on here is 10-year yields, and 10-year yields in which we saw a big move higher in them in the late summer into like September, even October. And that was when we had that kind of risk off flavor in the market. And then if you remember, end of October, early November, it was really I call it the Janet Yellen rally. That's where she kind of decided that the Treasury was going to issue at the front end of the curve and not deeper in the curve, which the market was leaning towards getting all the supply from the Treasury and it realized it couldn't, and so it's short duration, so it had chase bond market higher, and so we saw yields come lower across the curve, and this was just a huge support for risk, and so as the yields fell. Now yields had been creeping higher. In fact, we were starting to look to break out. Now we'll see if they follow what the Fed's saying, or if they follow what what the commodity markets are saying. I think at some point, especially when we look at the fact that the Bank of Japan is kind of backing off its yield curve control, et cetera,
Yeah.
and knowing that the Japanese investor is the largest foreign investor now, I think U.S. yields do have to probably continue to stay sticky, if not move higher. And I just these are just to me things that the Fed's going to have to contend with.
Yep. So that gets into, let's talk about labor a little bit, because again, one of the things that struck out to me about Powell's comments was that he called out labor as a potential reason to cut rates sooner than later, and that's part of their dual mandate. And one of the things, there's been a lot of folks out there talking about for months now, kind of the two states of the labor market. You've got these kind of strong prints on jobless claims, but then they've been revised downward. If you kind of drill into the hood, you see that it's kind of certain corners of the it's really services that's leading the way. Manufacturing's in a recession. Weekly hours are down, and so there are definitely cracks in the labor market. Like this one being continuing jobless claims versus initials dropping. What are
Yeah, and I mean, if you go back to that, I
yeah,
mean,
sorry.
that's something that people point to. It's one thing when we get these jobless claims, but the fact that the continuing claims are staying much more sticky suggests that people are more permanently out of work in some ways, and so that's definitely a sign of some weakness here. And I think there's it's definitely pockets. I mean, but it's big pockets, right? We've seen a pretty major disruption from AI and the technology landscape, and it's seen a lot of firms, and maybe it's or maybe it's kind of upskilling and getting new technology skills in there. But the technology firms were some of the early ones to let people go, and frankly, it's helped their margins. If we look, they had some of the best earnings last year because of that. but that's been a source of weakness on the labor front. And a lot of those people maybe found other jobs right away. But I think that, from what I understand, is getting a little bit even harder to do. And we know in financial services, it's in consulting. I mean, there's plenty of stories of the bulge bracket investment banks and the big blue blood consulting firms are just not hiring. And so there's some at the top. I mean, these are some of the most high paying jobs, and that's where people are really struggling. Now, yes, government's doing okay. Healthcare's hanging in there because people are getting older and we need more healthcare. But that the construction of the labor market is seem where we see the strength and where we see the weakness is pretty interesting too, I think.
Well, even too, there was something, I think it was Double Line. You had something a couple of weeks ago. They looked at the SOM indicator at the state level, and they said, it's consistently going up. It was 20 states, then 22, then it's that the number of states where the SOM indicator has flipped is increasing, and it's increasingly just a handful of the bigger states kind of carrying the load. It almost feels like the Mag 7 carrying the rest of the stock market. We've got a couple of big employment centers that are doing the same. So this is another. Take us through this. This is what new orders, right, versus LEI. The LEI has been kind of this has been kind of an interesting couple of quarters for leading economic indicators.
It has, and so there's a couple of things that I'm looking at in this one, and the blue line is the leading economic indicators, and that's itself an index of about 14 or 15 different indicators. And it does exactly what it does. I mean, the conference board puts out leading indicators, coincident indicators, and lagging indicators. And if you plot them through time versus GDP, et cetera, what you find is they do exactly what the conference board says they're going to do. Some are leading, some are coincident with the GDP, and some lag GDP. And so I like to look at it, and I like to actually look at the individual ones too, because it's important that we get inundated with so much data every day to know which of those data points are leading versus which is lagging, right? And so if a lagging indicator comes out, whether it's strong or weak, it doesn't really matter. It's like, because that's in the past, it's in the rearview mirror. It maybe confirms what we knew happened, et cetera. But as investors, we don't care because we care about where things are going, right? And the leading indicators tends to do that, and it has been, it has certainly been bleak for the better part of the last year or so. Now, the other thing I like to look at, because I tend to look at the ISM instead of the GDP, and the ISM, which itself is leading, as well as the S&P 500 is leading, but the level of the ISM and the move in the ISM tends to be a better predictor of S&P returns, and that's why I like a little bit more the GDP. Like, we'll get the final GDP, whatever, in a week or so, and it'll be the final revision of Q4 GDP.
Yeah.
And by the end of March 2024, I don't care about 2023 GDP. I care about December of 2024 GDP, if anything, right? So the GDP doesn't matter so much. Now, what the white line is within that ISM data, they have a new orders component and an inventories component. And so I look at the ratio of new orders to inventories, and that actually leads the headline ISM. And so the ISM itself is leading, and the new orders to inventories is actually what I would call anticipatory. It's ahead of the leading indicators, that ratio. And there's an intuition to it, right? When we see new orders picking up, that's a good sign that people are feeling better, right? And in addition, when we see inventory starting to build, that's an early sign that things are looking pretty bleak, even if we haven't seen it in the headlines yet. And the ratio of these, where we're seeing orders pick up relative to inventories, or inventories drawing down faster, et cetera, they tend to do a pretty good job. And I will say that just looking at the ISM last year, and looking at the fact that it breached below 50, it looked like it was going to go below 45, et cetera. I was pretty bearish on what I thought would happen with the economy. And I didn't pay attention to this, even though it's an indicator I've looked at my whole career, because all of last year, this new orders to inventory ratio was pointing to stronger times ahead. And I ignored it to my peril, because I was looking at things like the leading economic indicators, and I was looking at the headline ISM, and looking at the yield curve, and some other things that I have a pretty good track record too. And just said, too many things are telling me that we have to have a tough economy. But the one that really kind of told us what was going on is this ratio of new orders to inventories, which has plugged higher, hit a peak kind of in January. Last month's readings pulled back a little bit, So a little bit noteworthy, but I think generally we can still see the trend is moving higher. So if you're looking for signs that the economy is going to have that soft or no landing, this is probably the indicator you want to look at, and it has a pretty good track record, so it's not one to ignore. And like I said, I ignored it at my peril last year.
Well, I even remember actually reading your newsletter throughout last year, and you said it. I mean, credit to you. You said, listen, this suggests, despite everybody, including ourselves, saying that 2023 was, looking like it could be a bad year and a recessionary year. This is the one that's suggesting that it isn't. So, yeah, I mean,
Well, I mean, we talk a lot in class about behavioral biases, right? And you don't want to have that confirmation bias. You don't want to only look for information that confirms your view. You want to look at all sorts of information, some that may challenge your views and others that may confirm, and then look at the preponderance of the evidence and come from there. But I think, if we're looking at financial markets, there's always something to learn, even if we think we've uncovered a lot of it. And I think we just have to, being humble is a in the markets is a pretty good characteristic.
Yeah, exactly. Well, you have to look no further than the crypto markets to understand that behavioral psychology is a huge, huge driver of finance. So the fact that Dogecoin still exists is all you need to see. This is another one too. This is interesting. So housing, I mean, housing has been a huge part. I've got slides in the back, but housing has been a huge part of the economy. When the number of dollars printed, balloon post COVID, a lot of people first saw that effect in their house equity. And so looking at housing versus S&P candidly is something I'd never seen before. So this is really interesting.
So this kind of came out of a conversation with having and talking to friends, et cetera. And of course, you see the mortgage rates are still, they've come back, from 8%, but they're still high sixes, low sevens or whatever, which again, in history is not really that onerous. I think my first mortgage was over 8% in my life, but it certainly has slowed down the housing market a little bit. But what I kind of see just anecdotally in and around, you know, where I'm going around the country and where I am around where I live, is that the housing market was still holding in pretty good. And you're like, well, what could possibly be driving it? And it's like, well, I don't know. Nvidia's going up a lot. People are getting wealthier in their stock portfolio. So I'm this. I just that discussion made me like, well, let's go look and see about what if I took median home prices and I divided it by the SPX and basically said how many units of the SPX would it take for me to buy a house. And so essentially the idea here is our house prices expensive or cheap relative to the stock market, right? If you had money to put in, should you put it into a house or should you put it in the stock market? And and I think when you look at this and you look at how things play out, there's other things that kind of jump out at you when you look at this chart over 60 years, which is what we look at here, is that there's also some demographic things that are going on there, right? We can look back to the 70s, all through the late 60s and all through the 70s, and that's when the baby boomers were kind of in their teenage years, et cetera. And so there was a demand for more houses. We also had inflation going up, right? Inflation of all, going up of all kinds. But and so house prices got to be priced at a premium to the stocks. And so at that point, if you could, you wanted to like sell your house and put it all in the SPX. Not that anyone did, but because that at one point, it was like 600, right? And so the 600 units, if you will. Um, it's just telling you that stocks were cheap relative to houses. Now, if you look at it, and you look at this, and you can see the iterations and the blips there around like the housing bubble. You can see
Yeah.
around like the tech crash. You can see those kind of popping in there. And what we're seeing now is that home prices in terms of the SPX have actually never been cheaper, right? And this is just, you could either say the SPX is too high or home prices are too low. The point being is that if there's a lot of ways you can fund your house. You're going to certainly take out a mortgage, but if you've been, getting paid in company stock or you've been investing in company stock and you've been watching it go up in the stock market, it can do pretty well. And this kind of goes back to again a discussion as I was thinking about this, a discussion we had about 5 years after the financial crisis when I think we were talking about how successful a lot of these firms had been that bought up thousands of houses, right, at a discount, and then put them into single family home for rent or whatever. Um, and you're like, and you watch the house prices rebound, and you're like, wow, they made a lot of money. And I remember a colleague of mine at the desk was like, yeah, but if you put that money in the SPX, you would have done even better.
Yeah.
And he was right, right? The house prices have gone up a lot, but the SPX went up even more. And so the SPX, and ever since the financial crisis, it's been a straight line where essentially you can see the blip in there in 2021 when house prices really kind of shot up. But um, the SPX has been so strong, and the wealth effect is so strong from that house prices actually look relatively, actually in 60 years of data, never been more affordable relative to a stock market. And I think that's something that's interesting to know, because when we look at millennials are in the peak kind of household formation age right now, and they've been working for 15 years or so, maybe more, and because they delayed a little bit of that formation. Um, and so, you've got people that may um, want to own a house and still want to move out to the house, and have maybe delayed that a little bit because mortgage rates were too high. But to the extent that they're sitting in stock, they're actually still can afford a house, and I think that's going to be supportive of the housing market. I think that's going to be supportive of the economy. I think that's going to be supportive of and lead to more stickiness and inflation, frankly.
Yeah. Um, one thing we talked about LEI, but one thing that was interesting that I hadn't fully appreciated was, and correct me if I'm wrong, but the LEI tends to be very focused more on the manufacturing side of the economy, right, as opposed to services, and that's part of the dislocation that we've seen. In why the
Yeah.
conference board kind of gave up on their recession call. But again, that's consistent with a lot of people, myself included, manufacturing was early to go into a recession. A lot of people were looking at that as a potential canary in the coal mine, and it turns out that services kind of bailed them out. And now it's kind of like Nvidia pulling the whole stock market higher. Looks like it's on the path to for a soft landing. Um,
Yeah, I think this is interesting. I saw those headlines too. Like when the conference board's basically giving up on his recession calls, basically saying they're giving up on their indicator, and that's a pretty bold call. Like who's the one that goes into the meeting and says that, like, hey, we've got this indicator
yeah,
we try to sell to people. Let's tell them that it's not really worth it. Um, and that's probably one where I don't know. It's their indicator. They can do what they want with it. But it seems to me that at the same time, to say that that's another way of saying this time is different, which are the four most dangerous words in finance.
correct,
And so,
exactly.
and so, I think that we sometimes maybe, what it's the idea is that there's maybe some exogenous shock that's kind of going on. I think the exogenous shock that's really supported a lot of things that we don't appreciate, and maybe that I didn't fully appreciate last year, is just the magnitude of fiscal stimulus. We started out talking about that, and
Yes,
at its core, GDP. I mean, we learned this in probably, I don't know if it's Econ 102, I think, in my school, with the macroeconomics, which GDP is consumer plus investment plus government plus net exports, right? And net exports basically nil, maybe it's slightly negative here in the US. But what's going on in GDP? Well, we saw consumer spending slowing down. Now, it held up better because everyone had their COVID stimulus, et cetera, but it held up longer, but it's been slowing down. Like corporate investment had been slowing down in terms of like major capex. It held up a little bit better because companies were rationalizing supply chains a little bit, so it held up a little bit longer. But even that started to slow down. And what really kind of kept things going has been the G part of it. The government, the fiscal stimulus had been, normally counter-cyclical, and this time it wasn't counter-cyclical. It was, they're pumping more money in just as everything was still doing okay, which we normally
yeah.
don't see. And that's what I think, that's the exogenous shock, if you will, that's causing some of these other indicators to not work, if you will.
Well, one thing that's interesting, and I talk to my team about this all the time, is because we have dozens of models for all different asset classes and things like that, and everything is rules based. And oftentimes, when you see a model behave very differently, way out of pattern, that in and of itself is the signal that there might be something exogenous behind the scenes. March
Yeah.
2020 was a perfect example. A lot you look at like the momentum guys, a lot of them got caught left-footed, but it's again that dislocation is signaling something else, behind the scenes. I mean, that ties right into this. Soft landing narrative has now become the default. I mean, these kind of surveys are always interesting to me to just see too where the zeitgeist is as it relates to obviously data, but kind of expectations going forward. It does make me wonder. There's certainly tail risks out there, and the Fed has got a needle they've got a thread in terms of, I think, still kind of sticking this soft landing, so to speak. It does make you wonder too, to what degree does this kind of catch people off guard en masse if something really falls out of bed.
Well, I think this is I mean, when you put things like this together with that, that, for instance, the data I think you mentioned that was double line, maybe the SOM rule indicator at the state level, where we're about half the states in the United States now are signaling a recession, and in and of itself, you're like, okay, interesting, but again, let's think about. But then you say to yourself, okay, now let's look at this and say 85% of the market doesn't see a recession coming, right? Only a 10,
Yeah.
11% see a recession coming. So it's one thing if a recession happens. It's another thing if no one sees it coming, right? And then because we saw the exact opposite of that in 2023, I would say that there were a lot of people calling for a recession and it never came, and that meant we had even better returns than we normally probably would have if people had not really bet on that. So I think the idea that so many people and basically no one sees it coming increases the reaction to it should it ever happen. I'm not necessarily saying it will happen, but because it's actually quite mixed. You see some things it says it will, some things it says it won't. But the fact that no one's looking for it, to me, increases the magnitude of the move should it happen.
Yep, exactly. Well, next slide, too. So we talked about, I mean, SOM indicator, you can kind of see here on the right. Sorry, that's just unemployment, but let's actually skip to the next one because I think this is where it's interesting. So this is coming from Variant Perception, which is another macro blog that we highly recommend people follow. But job openings, so again, this is kind of starting to look under the hood now of the labor market. And one thing that I think is interesting too is looking at CEOs' expectations going forward, right? Because they're the ones ultimately that are planning on whether to hire or fire, and then just job openings, versus hires. So in terms of kind of where people can get jobs, and then just what's available on the supply side from the jobs, as opposed to labor participation rate.
Yeah, and I mean, there's obviously a few takeaways you could see here, but obviously, you look at the hires and openings, and in some ways you can think back to the data point that got a lot of talk back in 2021, I think it was the JOLTS data, the Job Opening and Labor Turnover Survey, which at one point showed like 11.1 million job openings or something like that. Now, there might be some nuances in that data where firms might be listing multiple openings where that don't really have them. Anyway, and to the extent that that hasn't always happened, the number was higher than it ever had been. And we can kind of see that here with the hires and openings in this variant perception data on the left. And it was as good an environment to get a new job as we ever saw.
Yeah.
And that's changed quite a bit. So now some of it is that we're coming off just what was kind of an epically good market to get a new job. But I think the other part here, what I'm seeing, and maybe I'm reading too much into this, is that um, there's two things. One is that I think a lot of CEOs are still a little bit unclear, unsure about what the outlook for the economy is, and so they're, you know, and again, I'm really kind of tied into like financial services, et cetera, and they think things are going to get better, but they're not going to hire anybody until they see them get better, because they made the mistake in 2021 of overhiring, and then they had to let a lot of people go, and so people are a little kind of hesitant to hire. But the other thing, though, too, I think is this AI impact, and that it's just to the extent that it's a productivity enhancing tool, which it is. It means that there's a need for fewer workforce. And so I think as people figure out their AI strategy, what we're seeing is that right now it's leading to more productivity, but either less hiring or more firing. And I think we're seeing it come out more in the less hiring aspect of it, because it really is kind of replacing that entry level worker at something.
Yeah.
Um, but
Well, like
yeah,
even a good anecdote is like BuzzFeed. I mean, didn't they fired like most of their editorial staff, and it's just, because that's their kind of typical output article is perfect for Chat GPT. And so,
yeah,
it reminds me, like we're both old enough to remember the kind of the internet boom of the 90s when it was going to be this huge, productivity boom, and it was. And it was kind of two sides of it. It enhanced the high type workers, but it replaced the low type workers. And so, AI just seems to be that kind of on steroids.
yeah.
Um, this is another one too that's interesting. Again, kind of looking at forward indications of softness in the labor market, which is again hiring intentions. And this one, the NFIB numbers, starting to look like it's really dropping off a cliff. So again, I mean, kind of consistent. It's just looking at, like you said, kind of the preponderance of evidence as it relates to jobs. One thing I don't think I have in here too is like if you look at the so-called WARN numbers, like the worker adjustment retraining notification. So it's like it's the notification that companies have to file before they lay people off. You're starting to see that tick up as well too. So again, there's to the extent that the mighty U.S. consumer who's flush with 401k and housing equity has kind of been driving, a lot of this, driving their portion of the GDP. Government's obviously a huge portion of it, but the consumer, to the extent that that starts to slow down, again, you wonder too if this isn't a linear, if this doesn't transfer, it's not going to be a linear trend down, but could it be exponential if something gets too far out of whack here?
Well, the interesting thing I think when I look at this is I NFIB I think is super important, right? And we don't maybe appreciate that as much with a market being driven by the Mag 7 or the Mag 5 or the Mag 3 or whatever it is being driven by these days. But 99% of companies in the United States are small businesses. I think 46% of all employees work at a technical small business. And so major driver of the economy. And there's a clear one of the key things you want to look at of what is going to lead the economy or drive the economy is the availability of credit and availability of money. And there's a clear haves and have nots, right? Large cap companies, the markets are open. Capital markets are really feeling good. Credit spreads are at 20-year lows, even if the absolute level of credit's higher, but the spread itself is at lows. And companies can issue debt and growth capital all they want. And so for large companies, the access to capital, the access to grow is there. For small companies that are reliant largely on going to their small commercial or small local or regional bank, the money is not there. Banks we saw, early in March of last year, a year ago or so, those some would rule that up to be idiosyncratic, and maybe to an extent it was because maybe those companies were the worst at managing balance sheets. But they weren't the only ones, and we've seen more and more banks fail, smaller banks, of
Mm,
course, and we've seen struggles with banks. We know that there's a wave of problems in the office market, but it's not only office. Commercial real estate overall is struggling, and banks are the ones that are going to have to refinance commercial real estate, and that's going to be that's a difficult part of it. And the bond portfolios haven't come back. And layered on top of all of that is that we're talking about this new Basel III endgame regulation, which is going to make it even harder for banks to make money. Um, and so banks are responding by just not lending things out. They're being very, very conservative. And small businesses are reliant on banks to get their growth capital, and it's harder to come by. And they're responding by saying, if it's harder to come by, guess what? We're just not going to hire people. We're not going to grow. We're not going to.
yep.
The NFIB capex intentions are low too. Like the small businesses, which again is about 50% of all employees, 99% of all companies are telling you times are tough out there. And so that's where it's tough to me to be in that camp of 85% of the market that says it's all good, soft landing or no landing, because there are things like this that say there are pockets of not just a little bit of weakness, but pockets of clear weakness. And so I think that's what makes it a little bit hard right now is that we definitely have a bifurcation where there's some things that are struggling quite a bit, others that are still doing quite well. And so the question is always, you know, that's not going to persist. So how is it going to come back together? Is it going to come back together by the large cap companies falling and coming down to where small cap companies are seeing things, or is it going to come by the broadening out of this rally and small cap names and small cap companies are finally going to see better times? And that's what we saw a little bit at the end of last year, right? That last 2 month risk on rally, we saw a massive move in small cap stocks, and
Yep.
the rally broadened out, and a lot of people thought this is it, right? This rally is finally broadening to more names, and it's really going to take off. But what we've seen in 2024 through 1 quarter or so is that we've kind of gone back to what most of 2023 was, where small cap companies are really, really struggling, and it's just some large cap companies are doing really well, but we're not seeing that, all in all. And maybe, frankly, maybe those are the things that Jay Powell's looking at, and why he still is still talking about cutting rates, even though this inflation data looks like it wants to move higher. So he did talk a little bit about labor markets, and he talked about the headline not being, the headline strength we saw not being a reason to not cut rates. And maybe he's hearing from regional Fed governors that there's other parts of the country that aren't doing so well. I don't know.
Yeah, no, absolutely. I mean, that would make a lot of sense too, for sure. One thing that I found super interesting, this chart on the right in particular. So again, the kind of the wealth effect has been extremely robust since 2020, kind of COVID, fiscal and monetary stimulus. But the degree to which, so a home bought in January of 2021, the average home equity growth has been over 120 grand since then. I mean, that's almost, kind of mind boggling. And so again, it's, you look at, you look at this engine of, basically government dollars that have, worked their way into the economy through the consumer and kind of powered this spending. But, that's a melting ice cube, to some degree, but it's clearly, it's clearly powering things forward, right now.
Well, it's interesting, and I wondered to what extent that this is playing into what we've seen in other things. Like, if you look at the labor participation rate of the cohort of 55 to 64-year-olds, early retirement, if you will, and that labor participation has come down each and every year. People are retiring earlier and earlier, and they're not all tapping into Social Security because if they're retiring in the 50s or not, right? You can't get it till 62. So this wealth effect in homes and in the value of their stock portfolios is clearly playing into that. And I think that the fact that they're retiring, and they're probably the ones that are demanding more services and going on vacations more, and probably the leading to that strength in services that you had referenced earlier today. And it all might be tied back to this kind of wealth effect in both the homes, as you show here, which is pretty substantial, but also in their stock portfolios.
Yeah.
And so I think that's something that you can't ignore. I know Alan Greenspan never ignored it. I know George Soros never ignored it. I mean, this wealth effect, that the reflexivity that Soros called it,
Yeah.
or the wealth effect that Greenspan liked to refer to, it's very real, right? And it's very real. Everyone knows it themselves. You know that you feel flush, even if it's your 401k that you can't access for many years. If it's going up every month, you're feeling pretty good, and you're gonna probably spend a little bit more money. And I think that's what we're seeing here. But at the level of a demographic that owned the most houses and had the most stocks, and is therefore doing the best.
Exactly. Now the flip side is too, and this is another thing we're keeping a close eye on, is, just debt, both at the federal level, which is obviously our deficit and everybody knows is too high, but also at the household level. Households are ramping up the credit cards, defaults are starting to tick up. So again, that's another, before I got into Wall Street, I worked at American Express pre-great financial crisis, and you saw it there, tick up, and you could almost like just pin that the recession was coming because utilization rates went up. It's, that's, there's households are ramping up the debt quite a bit.
Yeah, and it's you're absolutely right. And not only are they ramping up the debt, we're starting to see the delinquency data start to tick higher too. And so it's not, if you wanted to be optimistic, you're like, oh well, people are just using their credit card to pay for everything because and want to get the miles, et cetera. okay, that's if they pay it off in full every month, but they're actually not paying off in full every month. So we can see even in the other parts of the granularity is that they're ramping up the card and they're struggling to make those payments too. And I think both of those are definitely a tough sign. And maybe this is the sign that this is maybe this is the millennial cohort on the other end that's struggling because they're trying to pay for things and pay for families, et cetera, in those kind of prime years. I don't know. It's an interesting dynamic for sure, and not a healthy one. I totally agree with you. I mean, there's just too much empirical evidence and too much logic and intuition of why this is a bad thing.
Well, and also, I mean, the big one is like interest, borrowing costs went up for everybody. And again, I have a slide that talks about this at the federal level, which is massively concerning, but then households too. If you can max out the credit card when, there's all these intro APRs and your rate is whatever, whatever it is, 7 or 8%. All of a sudden, when LIBOR ratchets up and you're paying, high double digit or, high teens on your credit card, again, you as a function of your household take home pay, it massively shoots up. And again, that's here's what you're seeing too is kind of that those borrowing costs for credit cards, personal banks, it's and that's relatively recent too. Basically all last year is when that went from 10% to 16% if you're looking at the chart on the right. I mean, that's one of those things that you have to imagine is going to start to impact behavior kind of this year going forward.
Yeah, and we mentioned teaser rates. I mean, it's not just on the credit cards or even into the cars. It's new home builders were offering teaser rates in some ways
Yeah,
on the mortgages too last year. And so that's something that's out there that you have to know about. And so that's something to be careful of because again, to the idea that if we saying that we think that you could have some sticky inflation and that that whole idea, well, I can just borrow now and it'll reset lower in a few months
exactly.
when it's not as clear that it will necessarily do that.
Exactly. And then here, this next one. So this is the U.S. credit card, and this is the big one I keep going to. Is if you just look at U.S. interest payments as a percentage of government receipts, this is definitely not sustainable. I mean, this is where I think people talking about commodity super cycles, Bitcoin going to $1 million, gold going to 10K, this is it. And it's we talked about this earlier, kind of the only real way out of this is for the government, I think, to inflate away the debt. But even that's a fine line because you can't, as much as they'd probably love to run inflation a little bit higher, that's at some point you just risk the masses turning on you. But what's interesting too about this, what I always think about is I had a conversation with an advisor a while back, and he's like, I'm worried that this is 2022. He's like, rates are going to have to go up, and he's like, what if the Fed takes rates back to 17%? And I was like, I think that's mathematically impossible because at that point you wouldn't be able to afford Medicare, Medicaid, Social Security, defense. Like the only way the government can pay the interest rate on that is to either default or start selling aircraft carriers to China to fund it. So this is something we're keeping an eye on to in terms of just kind of long-term purchasing power parity, if nothing else.
Well, and I mean, this number doesn't even include Social Security, Medicare, I'm going to guess,
Yeah,
right? And so, um, it doesn't even include the those types of liabilities. And I think you're right. This is what gives me confidence that inflation is going to stay higher. Not that I like it, but it is. But this is also the argument. You don't need any other argument to be long Bitcoin and or gold. And I would encourage people to be long both, frankly. Why pick your poison? Just be long both because this isn't sustainable, right? We had last year was the first time I think interest payments, total interest costs surpassed our defense spending. And so a lot of people are just quick, oh, we got a big deficit. Well, just cut defense spending. Well, I think what one people don't understand is that defense spending as a percent of GDP hasn't been lower since I think since 1960s, right? It's already been cut quite a bit. Could it be cut more for sure? But the thing is, these are the things that are the non-discretionary components of the fiscal budget are just a much larger piece of the puzzle. And so that's where people say we've kind of kicked the can too far. We're losing control of being able to cut things as a way to bring things back into control, because the things that are driving this now are not discretionary items. They're things that we're already on the hook for. And so that's where things get tough. And that's where, again, going back to the idea that we could default, restructure, or inflate our way out of it. And the easiest thing for politicians to do is to inflate. And I'm not saying it's the best, but it's the easiest for them. And it ultimately leads to, as we've seen in other countries, it's led to the need to ultimately then go back and either default or restructure. So it doesn't preclude those other things. It's just but that it's the first thing I think they're going to try, and I think that's what's going to happen. And some would say, well, this can't persist, and so if it can't persist, it won't persist, and that's why the Fed wants to bring down rates. But the problem is, if you bring down rates, you just add more to the inflation problem at some
Exactly.
point, and at some point, then it becomes even more out of control. So it really kind of balancing here, and really kind of a tightrope that they're trying to walk, and not so sure that they'll be able to do so. And so to me, I look at it and say, I think to myself, if as I think of my portfolio, I'm like, I want to be positioned such that I'll do okay if inflation moves higher, because I think that's the path of least resistance. And so I want to be in those assets that are going to be protected in that event.
Well, yeah, I think we're seeing, again, like commodities, I think we're seeing the commodities complex, start to respond to that. Um, so back to commercial real estate real quick, because again, a lot of people are looking for the canary in the coal mine, and I suspect this might be it, because the propensity for spillover effects are very real. But this also, this turn on the right surprised me too, because it's not something that we've heard a lot about. I mean, a lot of people are pounding the table on kind of CRE, as the problem child. You've kind of seen the headlines of big hotels in San Francisco, landlords handing over the keys, but the share of delinquent loans within commercial real estate CLOs is huge, or at least 60 days plus delinquent. So this is, and this is just kind of starting within the last quarter. So again, this looks like, and correct me if I'm wrong, but a lot of the regional banks are really kind of the big player in this space, right? In terms of commercial real estate loans. And
They are for sure. I mean, when we talk about office in particular, it's the money center banks that are going to be on the hook for a lot of the office, of course. But for commercial real estate, broadly speaking, it's definitely regional banks. And you're right. It's the office buildings in San Francisco getting turned over. Just literally walking away. The key mail that the key mail that we had back in the housing bubble
yeah,
financial crisis.
yeah,
We had a building change hands, sold by a Canadian pension to others in New York City for $1 because they didn't want to invest any more money into it. We had a building in Chicago right in the middle of the loop, trade at $4 per square foot, which was down 90% from 2018. And Chicago didn't have any mega boom. That just kind of shows you how painful it is. And so it's getting to be where there's more and more of those stories are kind of creeping out, and we're just hitting this wall, right? 2024, 25, 26 is the wall of where this stuff has to be refinanced, and that's the catalyst for all this activity to occur. Is you do everything you can up until that last day when you have to finally refinance that, and if you can't finally refinance and the economics aren't there to do so, you walk away, or you hit the bid down 90% or whatever you have to do, because the cash flow just doesn't justify it. And as we're kind of hitting this commercial real estate, wall of refinancings, I would expect we're going to see more and more of these types of stories. Now, to what extent can that real estate be repurposed? Most people I talk to in the real estate industry say, yeah, it's not really possible, right?
it's very difficult. Yeah,
Every mayor wants to say, we'll take that empty office building and make it affordable housing. The reality is the cost it takes to convert that into housing doesn't make it affordable. And so it just doesn't work. And we've seen it tried in places, it just doesn't work. In Chicago, that's what our mayor's talking about, is all our empty office buildings make it affordable housing. I just don't see it happening. And so I think this is going to be one of those problems that's going to stick with us.
yeah, yeah. The only people that sleep in office buildings are first year analysts at iBanks. So, um,
Exactly.
Last couple slides here. Stocks. So, with everything, tech is still kind of driving everything. It seems like it's getting narrower at the top. Like you said, I mean, there was some green shoots that looked like kind of a broad, increasing breadth of stock market rally, a while back. And, EPS revisions are starting to look a little bit better for the S&P, but to credit tech, Nvidia came out with their blowout earnings, and it is one of those things where it's like, maybe this is just kind of the fourth turning, a new paradigm of kind of AI led revolution. But what are your thoughts?
I mean, it's easy to say Nvidia is overvalued and compare Nvidia to Cisco in 99 or whatever. The fact of the matter is Nvidia just comes out and continues to put up big, big numbers. The expectations are quite high, but it continues to outperform those expectations. And so I think, yeah, you have to look at it and say, yes, the expectations are high, but I'm not going to sell that until they disappoint. And I can't imagine anyone who's long Nvidia has any interest in selling it right now. It's hard to. And so, and as you see here on the right, ultimately it's earnings that drive stocks, right? And the economy drives earnings. And where, it's been a mixed bag, perhaps at the aggregate level. The earnings were pretty flat, if you maybe up small overall. I think flat here you had over the last year. Um, but the sectors that are doing the best are the ones that are delivering earnings growth. Tech is doing the best because it's delivering the best earnings growth. The ones that are struggling, like energy and healthcare, are you're seeing those sectors are lagging the rest of the market. Now, what I would say with energy materials is as commodity businesses and commodity sectors, as prices go higher, the nature of a commodity business is it's got a lot of operating leverage. They don't have a lot of pricing power by the nature of their business, but as prices go higher, it all drops to the bottom line. Because
Yeah.
once you get above your fixed costs, it's just all gravy. So I would be probably, given my views on inflation, optimistic on that energy materials sector for sure.
Yeah.
Healthcare is an interesting one, right? There's a lot of, I mean, AI could potentially disrupt healthcare, but at the same time, if there's going to be one sector that's going to probably be a little bit of a political volleyball, it's probably going to be healthcare, given that a lot of voters care a lot about healthcare. So I would, that's a tough one. You have to be really careful in picking names in that sector. In tech, I think you have to look at it and say, okay, you know, I think what we're seeing is even within tech, there's some of the breadth is declining, but the winners are still doing well, and I think people will continue to ride those. And so, if we've got energy material earnings turning back higher and tech still doing okay, S&P should still do fine.
Yeah.
But I would imagine that again, the expectations are much higher in tech than they are in energy materials. And so we have seen some rotation out of tech into energy in the last couple of weeks. I wonder if that was just a little bit of paring back some risk into the FOMC meeting, and maybe I want to keep an eye on see if that continues or if that was just again a little bit of risk reduction. But I just look at the hurdle rates and they are high, but the companies continue to achieve them, and so you have to respect that.
Yep. Um, Last slide, equity risk premium. This is one too where we've been very focused on kind of OCIO side of our business in terms of just calibrating for the next 10 years. And, stocks have had a phenomenal, 10, 15-year run. But now with, a normalization of interest rates, interest rates compete for capital like anything else. And all of a sudden, I mean, you've heard T-bill and chill. A lot of people were just thrilled to get 5% on their cash and not have to deal with anything, and should weigh on stocks long term. What are your thoughts on that?
Well, there's two things I would say to that. One is that you're right. 5% on cash is not bad at all, right? There isn't, you know, you're getting something to do nothing, right? You're getting something to sit and have dry powder, and that's what cash is. It's dry powder. It's not opportunity cost. Um, it's easy to say that when the market's not up 20%. If the market was up 10%, you could still make a case for it. And I think FOMO is what we're seeing. Some people want to get out of that, but I would say, the bigger thing I look at big picture wise when you think about this earnings, the risk premium, is that there's just no margin of safety. so a risk premium that's close to zero, or if you look at it from a Nasdaq standpoint, is actually negative. Um, that doesn't mean that the stocks have to go down tomorrow. It doesn't have to mean the stocks have to go down the next year. But what it means is that there's no margin of safety. So if anything goes wrong, that the stocks have, they're not priced for, they're priced for perfection. And it's the same kind of going back to that idea we saw where 85% of people are expecting things to be just great. Everyone, if the market's priced that everything's gonna be great, and participants are expecting everything to be great, that's fine as long as everything's great. But if anything does go wrong, that just leads to uh, a larger potential risk off move. So
Yeah.
that's where I think if you're invested in stocks, and I understand why people are staying invested because the companies are still delivering. Given that the cost of insurance is so low, if any extent that people can add convexity to their portfolio, I just encourage them to consider it and take a look at those types of things, because things are priced for perfection. And we just know this going studying markets through time, that there will be something where there will be a disappointment at some point, even if we don't know what that will be. We highlighted a number of different things that could go wrong. Not to say any one of those will be the one that it is, but the bigger move might come if it's not something that we were expecting. And so the fact that there's no margin of safety is just something I think people have to be careful of. And the fact that the cost of insurance in the options market is relatively inexpensive, it's worth
Yep.
trying to find more convex ways to implement your views.
Yep. Absolutely. Well, if nothing else, it's going to be a very eventful year, I think, for watching the Fed and kind of seeing how that pans out, particularly in an election cycle year. So this has been very helpful and insightful as always, Rich. Thank you for your time, and yeah, would love to have you back next quarter and just kind of reassess these charts, see where we're at there.
I always enjoy the discussion, Ben. That was good. I'd love to come back and talk.
Awesome. Thank you.